I'm joined by my good friend Lloyd Schreeden and fellow pro-advisor. Lloyd is with the CPA firm of Stern, Corey, Schreeden & Morgan, a professional accounting firm here in the Santa Clarita Valley. And a good friend of mine I always turn to for advice when it comes to important things. I want to talk to you today about the IRS audit, because that's, I think, one of the top fears of people in this country is getting audited. I got to ask you, do they knock on your door one day and said, "We're auditing you, show me everything"?
Hopefully not. When they see that there's a problem and people haven't filed tax returns, they could come knocking on the door, or they might come out in pairs if you owe money and you're not responsive. But if you're responsive and you're answering their letters, they're not coming knocking.
And normally it's a letter that comes to the taxpayer?
It's coming to the taxpayer, and now it's coming to the spouse as well. So they're sending two letters out to make sure that they both have them, just for the new rules that they have.
What is the likelihood of you being audited?
Likelihood for the statistics from 2010 is about 1.1%. There was 143 million tax returns that were filed, and about 1.5 million audits. And
they have a tendency to go after those higher income earners because there's maybe some more money to get there.
In the past years, they have gone after the high income earners, and the last few years they're going after lower income earners as well, because they think that niche is going to be where they're going to be able to collect some tax dollars. For example, of the 1.1% of the audit rate, about 4.7% that they have audited in 2010 for gross income in the 100 to 200,000 range, which they've never done before.
Yeah, so they're going after both areas. Let's talk about red flags. What are some of the red flags? Your income looks too low, duh.
Yeah, and people don't realize it. And with the economy, the way it's been the last few years, people have a good explanation for their income being low. They have a point value system called discriminant functional system, where they assign point values to everybody's tax return, and they're going to pick the ones that are over a certain level. For example, if somebody's mortgage interest and property taxes, let's say, are 60% of their income, they're going to want to know how they were able to afford to survive. And the other issue would be if they have business losses, or they have negative taxable income, or they have earned income credit, that if they're in the poverty level, and they have children that they're claiming as dependents, and some people are being able to get refunds without paying anything in, and that's been a high audit area as well.
Well, what about that hobby? What about doing your horse betting or horse racing, or your RC cars, or all the hobbies you have, and you're writing it off?
The IRS has been after these areas. They want you to have a profit in 2 of the last 5 years. It's not mandatory, because if somebody has a true profit motive, then the IRS will allow it. But if somebody has, let's say, for example, that they're involved with horse racing or horse breeding, or horse showing, that and they're only spending 10-15 hours a week on it, and they have a 40-hour-a-week job, they're going to want to make sure that there was a profit motive. So they will disallow the losses. Photography is another area that I've seen that the IRS going after for hobby rules.
Yeah, the bigger and bigger. Let's talk about the economic reality. Someone is maybe not reporting all their income. What do they look at? What are some of the things they can look at outside of just what you've provided them?
Good question. And with that, the auditor, many times that they will go do a drive-by somebody's house and see what they have, because they're showing a very, very low income. Economic reality audit would be that they will look at the DMV records to see what vehicles they own. Let's say they have a big RV or boats, or that they will look at that they have
credit report.
Credit report would be an area too, and property profiles to see what they own, and they will back into the amount of the income and charge them income tax on it if they think that there's a problem.
What are some of the trouble areas, the high audit areas? What if I happen to go to Hawaii for that special conference? They look at travel.
They will look at the travel. They're going to want to make sure that the wife and kids were on a separate payment than on the business. And they're looking at travel, they're looking at meals and entertainment, they're looking at promotion, auto expenses, and in these areas they want to make sure that there's business use. So they're going to want to see logs, and they're going to want to see the who, why, where, and when on the meal receipts.
So the reality of it is, if you just have good records and you document this, really you're going to be covered, aren't you?
That's the important thing.
In most cases.
That's the important thing. If you have good documentation. We went through helping out a taxpayer recently, and the auditor really liked all the backup they had. And they said, we'll allow this if you could show us personal meals as well. So they want to make sure that there was something on the personal credit card as well, just to back it up.
I've heard use a business credit report for business and use a personal business card or personal for personal stuff, business for business. That way you can show, hey, look, I'm carrying 2 cards and it's separated.
That's ideal. The IRS doesn't like to see commingling, and it can get you in trouble.
Yeah, good. Very, very good. Last but not least, charitable donations.
The IRS has been after that a little bit lately because they don't allow a de minimis amount like they used to. Small amounts, if it was $10 or $20 a week to church, that they used to allow that. Now they want it all documented, and also in reference to non-cash donations to Goodwill, Salvation Army, Vietnam vets, that take pictures of what you donate and itemize every item and see how you came up with those items. And if it's over $5,000 for the year, they're going to want a licensed appraisal of all the stuff that you donated.
And they're going to want some proof of it. So when you're writing the check at church to put the money, you put the check in instead of the cash.
That's exactly right. And also be careful too with if you go to an auction, at the church, or let's say out here at the Boys and Girls Club, that if you're writing that check, that it's not necessarily a tax deduction, because only the excess over fair market value, because you're receiving goods or services.
Yeah, well, thanks for the update. Those that want to reach you, if they do get an audit notice and they're fearful, they want to contact you and get some advice.
Stern, Corey, Street, and Morgan at Lloyd at sksm.com or 661-286-1040.
Yep, that's a great one, 661-286-1040. I get it, right? We're going to jump to a quick break, and we'll be right back.